We saw this with Euro Swiss when the euro was collapsing back in 2015. Is it hurts American industry because all of a sudden they can't compete, and that's where it gets controversial.
And that's where the election campaign rhetoric steps up about trade wars with China, I guess.
So it's good from an inflationary perspective, but for American industry, they can't compete.
Hello, welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive, Onyx Capital Group, and today I'm joined with the usual Martha, James, and Vincent. So the week just past could best be described as a de-risk week after a calming in tensions in the Middle East was met with an altering monetary policy landscape. Oil markets gave back some of the length built up in the peak of the tensions in multiple contracts, whilst equity markets in the US waned and the aggressive gold buying cooled temporarily. So what now? Well, when a narrative starts to lose the market's attention, it switches to the next. And we are back to looking at the underlying oil market for our next indication. So this is our speciality, and let's get straight into it. Vincent, you want to start us off?
Sure thing. So it's been a week of stagnation and mean reversion in the crude oil markets. $90 oil was clearly very short-lived. The previous weeks there was a lot of market hysteria, a lot of traders were mentioning it was quite dangerous to go short given the potential escalations. But of course, it has been very much a week of de-risking. Previously, the bullish news was driven by spec positioning cycles, which drove prices beyond fundamental justifications. But however, this past week, the geopolitical risk premium has well and truly waned. Although the exception came from last Friday, where Israel had a retaliatory strike aimed at Isfahan, Iran's third largest city, which is also close to where its nuclear facilities are located. However, given that in the following hours, both sides had downplayed the severity of the incident, which contributed to easing concerns of a wider conflict. And as Javier Blas had treated, it was very much an escalation to de-escalate. And of course, considering that the market is relatively well supplied, there's relatively high spare capacity among OPEC countries, including Saudi Arabia, the UAE, and Iraq, which their cuts are keeping 5 million barrels per day out of the market, which is more than what Iran produces. So it is all geopolitical risk, but no concrete physical supply is actually being disrupted. So the $90 break was very short-lived and prices are down back to $87 levels, which is quite reasonable. Brent spreads around $1, reflecting a moderately tight market. So now the market is very much waiting for further cues, and that comes down to the underlying oil market. So the previous narrative is waning down.
Yeah, I think it's, as I said, I think the market's just like now putting this to a side, not so interested, quite abruptly, not so interested in the Iran-Israel situation. I think it was tracked like so step by step that there's nothing to really be concerned yourself about. It was almost bizarre how much of a show it ended up looking like, and we talked about this a lot last week, so we won't keep banging on about it. But the spare capacity argument, the only thing I would say about the OPEC and all that have so much oil in the background. Yeah, but they have for so long. And if oil goes up to 100, 110, 120, if they didn't bring it back online in the peak 2022 crisis, why would they bring it on this time? So people hoping for that. I think it's just retrospective narrative, like, oh, the market didn't believe because this is just bollocks. It's the market was long, the market got too long. The market then had to de-risk when it didn't escalate, and then that caused a pretty reasonable sell-off, but we're talking $3. So it took about into the third day for people to really kind of seemingly, in terms of the short-term money, give up and sell back the maybe the length that they bought into because of the tensions. And once that happened, I would say probably like even just Friday, we kind of consolidated, and then markets turned its attention to the underlying, and we've got the front Brent spread as an indication. So the front Brent spread, June, July. So June, July versus July, August, it was pretty flat. That fly was pretty flat, and the outrights are about 75 cents or whatever it was, maybe as low as 70 cents. And then suddenly the front spread starts performing. So now the front fly is like between 15 and 20 cents, which is a very like strong fly out of nowhere. So then we have at least a week before expiry, you have the limit day. So there's a cutoff point how much traders are allowed to hold into the expiry of the Brent contract. So you see a lot of de-risking in that moment. So it could explain a lot of why the front spread was under pressure, as well as people de-risking because of the Middle East tensions or the calming of the Middle East tensions. But as soon as that's over, you've now got the fund rolling being over. You've now got the tensions people have got out of their length. So the fact that the front Brent spread's really performing quite aggressively is quite a strong indication that North Sea traders want the oil. It's looking bullish again for them. I think that's probably going to lead the market now. So if it's a strong expiry, that's real strong physical cargoes that are sought after for 2 months forward, which is quite a big kind of strong sentiment indication. So that approaching $1 per barrel again, the front time spread, is clear evidence that we're kind of in a strong market. And this is what I wanted to focus on today, because the talk went from de-risking this week or the past week to the whole oil market's weak. The refinery margins weakened, gasoil's big sell-off. A lot of people starting to look like they're actually not doing too well. And suddenly, now that we've consolidated, maybe I guess I'm heavily suggesting it was just going too far and we're going to go all the way up again. But I think that's a discussion I want to have. So could we just go straight into that, Martha, maybe on the refinery margins?
Yeah, of course. Before we look at our specific Onyx and one refinery margin, I think it's important to talk about the margin that's been the talk of the market a lot this week, which has been the simple refinery margins. So the simple refinery margins have fallen into an area of non-profitability, and so it's important to look at the difference between these straight run products and more complex products like naphtha and gas oil and fuel oil. They could see some support from this, and we did initially see some naphtha get some support from this, and we've seen it supported since.
We're seeing support because when refinery margins go negative, you make the assumption that refineries aren't going to run, and therefore product versus Brent tends to perform because people are going to assume there's not as much refining capacity online.
I think it's more reactionary to the news as well, because this is put out by a few different news sources, and I know we're saying it in our traders chat and stuff, because the actual physical impacts will not happen for maybe a month or two. So it's important to kind of recognize that if you're looking at kind of the longer term, that this may be a significant impact. I also think it's going to be a really important thing to look at in the future between the relationship between gas oil and gasoline. The difference between gas oil and gasoline can be looked at as a kind of heavy and light divider in the refinery margin itself. But as we see all of these products, these straight run products, being made less of, a lot of them can be put towards the gasoline pool, and blenders could be looking to maximize gasoline production as it's being so successful, and it's all being produced well with these other products. But it's also interesting further to look at vacuum gas oil, which is made separately. So if you think of a refinery, you think of just one fractional distillation column. But if in a more complex refinery, you'll have a second fractional distillation column where it's actually under a vacuum condition, so that it can break the longer hydrocarbon chains with easier. And this creates vacuum gas oil, and because diesel is so cheap, that diesel can now be used instead of vacuum gas oil to create gasoline. And so I think it'll be really interesting in the future, kind of a one to watch, to look at this gas oil gasoline comparison, especially due to how closely correlated the US Gulf Coast gasoline and the European gasoline has been at the moment.
Yeah, I think the interesting thing for the derivative market being a forward curve is that when you see this happen, so let's say vacuum gas oil margins, so then changes the way you behave. So you say, usually I would buy vacuum gas oil, produce diesel and gasoline. Now you're saying diesel's so cheap, I can just put it into that pool and just just try and gear it to make as much gasoline as possible. That's all happening relative to the prices in the forward curve. So yes, if a refinery was to go in and lock that in, so try and basically hedge that, right, which is essentially probably selling a hell of a lot of gasoline. It will have an impact on the derivative market, but it hasn't actually happened in the physical market. So people always need to remember, right? So it's much more interesting to look at it at the very prompt with the physical pricing, because that is how a refinery will actually make the switch. So if they do make the actual switch and there's actually different production changes in the different products, then seeing these negative margins or strong blending economics, whatever it may be, if it's happening in the very, very prompt, in a few weeks' time, you might actually see the impact on the next month's prompt physical. But I think people get too carried away thinking, well, it's happening in the it's happening in the forward curve, therefore this is what refineries must be doing. No, it's only going to happen in the physical market if something happens in the forward market and the refiners go in and lock it in with a hedge. If they don't do that, it converges back, right? It will go back to where it should be. This is not a slight on you at all. It's just generally what we've got to remember is when these things happen, unless there's a very good reason why it should, this is what people do. They come in and mean revert it. So should the vacuum gas oil margins be negative in the forward curve? And if the answer is yes, because diesel is just, no one wants diesel. Chinese economy is so bad. That's a big source of the demand. There's more exports coming out of the region. No one wants diesel. We're producing too much of it. Blah, blah, blah. Then okay, it can make sense. But if it's just a function of the forward curve because everyone was too long diesel, and then now they're all rushing to the exit door and selling it in this last macro sell-off, then it's probably gone too far. And an indication that it's gone too far is that it's now interrupting the vacuum gas oil blending margins. So people come in and mean revert it and go, yeah, diesel might be weak, but is it so weak that it's going to be used in the vacuum gas oil pool? No. So they'll come in and buy it. And then that's what we've got to really focus on. So do we believe in this negative situation? I guess we probably don't. It's just, as you say, gasoline has been too strong. Maybe gasoline this is a great indication that it's a good time to take profit because the whole world's long gasoline and very long going into Q3. But are they now too long because of what's happening? And that's probably a great way to frame it. So on that note, I think this is all basically been driven by diesel, right? Diesel is the big interesting thing, the diesel versus Brent crack in particular. So what was the big, what happened this week?
Same thing that's happening in last week, that it's just been so weak. Same story again. We're under $20 per barrel in the crack, which I think a lot of people were expecting to be somewhat of a support point, but it hasn't been. It's went down below $19 a barrel, and now it's back up above $19 a barrel. But we've seen bullish EIA stats of a draw of 2.76 billion barrels compared to an estimated 900,000 barrels, and this has just been absorbed really well by the bearishness, and there's been that lack of support. That would be such a good excuse for people to kind of rush in. But I think something interesting from the stats that we've seen is that we saw a really significant de-risking from ProdMerc positions in the last EIA report. So for the week to April the 19th. So the ProdMerc players took around 7 and around 10 million barrels off for long and short positioned players respectively. So I think that could be maybe taking off risk or taking off hedges, and we may see these are like substantial players in the market. We could see these being put back on and like there being less OI in the market, and it can maybe be jumping up in response to this. But there doesn't seem to be any kind of bullish motivation here. It's all pretty pessimistic. The ARA stocks are high, but there was a draw last week, but again that was ignored as well. But the levels are just so low, and there has been mixed interest in the physical, but I think we're going to need to see something a bit more.
Yeah, it's that old saying again, like we're in a condition of overbought or oversold. And I think while we're transitioning from probably an overbought market, it's still got a way to go to find its like floor from a momentum basis. And we talk a lot about CTAs, algorithms chasing that momentum. We've got to remember it's on all futures. So gas oil is a future, heating oil is a future. There's CTAs active there as well. So, this continued momentum, trying to find that floor, which is kind of like a way of saying trying to find those stops. Then once you find the stops and they're triggered, that is when you can have a floor on a technical basis. And then, as you say, like, is this an indication of where the crack should be long term? I mean, in my kind of trading experience, 18-19 was a very strong crack in diesel. So it's only the last couple of years that it's 3-4 years that it's now seen as more like it should be 30 and 40 in a strong market. That is a new thing, I would argue. So that's one thing to consider. However, if you are bullish, and you're bullish because of supply being held back from the market, if that's your core reasoning because of OPEC, then it still makes sense that as that materializes, the diesel crack has to perform because it's a mainly heavy sour market that's being squeezed from a supply standpoint. And so, if you are bullish on that basis, this is a low crack. I think that's a fair point. So if anything, it's a kind of taking their time. Let's wait for the time to get long distillates, but probably people have been quite burnt from being long. So there's that consolidation period. But I think it's worth talking a little bit more about, I love studying the refinery margins and the individual cracks, because they all kind of, if one supersedes and one's got too much focus, like diesel was the one in 2022, then lots of cracks have to give way to allow for that strength. Otherwise, the refinery margins just get way too strong, and it's just, it doesn't work like that. Things have to give way. So what is giving way at the moment? Diesel's giving way probably, I think, because of the gasoline strength. Like even naphtha has been stronger again, right? Probably dragged up by gasoline. So what is the story there? Do we think this has gone too far now, even though we're not anywhere near or not quite there with Q3? Have maybe, if all this shock happening in the cracks and maybe even the physical market, it's probably an indication gasoline's gone too far, no?
I think that last week we saw a pretty poor performance in gasoline, and I think that this is probably going to continue this week. We'll talk about it in our trade idea.
But that's
later.
good. Yeah, but you see my point is in like, if you're constantly, if it's believable from a physical standpoint, the end user can kind of accept it from a consumer point of view, and if it's all in line there, and that allows things to play out on the forward curve. But if what's really keeping up the forward price of gasoline cracks, gasoline versus Brent, is paper flow, is people's positioning, then a great indication that that's gone too far is where there starts to be ramifications in the refinery margin and other products, and then actually leading to changes in the way refiners are structuring their production because of the forward price for gasoline. So the paper traders are genuinely forcing a shift to vacuum gas margins, all that. And is gasoline that strong? I mean, no, it's just, we think it's going to be strong. The market thinks it's going to be strong, so it buys into it, but it's going too far now. It's protecting almost like a fungible token. You know, it's like, it's not actually there. And the indication is refiners are changing everything they're doing because of it. So, you know, if refiners come in and hedge this quite aggressively now, i.e. sell gasoline and basically buy everything else, then I think that downward pressure is going to be too much. But I'll leave it for your trade idea. But that's kind of what I'm thinking. So James, I think it's a good time to say, look, you know, gasoline, diesel, these are the core products we talk about for the refinery margin as an indication of macroeconomic health, right? So they are linked. We have had, you talked about your macro Mondays yesterday, a bit of a shout out, it's a bit of a pilot to see how that goes. That was very interesting. And you were talking a lot about US strong economic data, right? That's the big thing. And I always kind of add to that, and not as bearish China, because that was really weighing down in Q1. So on the backdrop of that, diesel and gasoline should be supported, and we're saying maybe too far. But what do you see going forward? Do you think there's a shock? As in, do you think we keep strengthening in the US, and do you think it will be way more so than people expected? Or do you think from a macro standpoint, people were expecting a bullish US economic environment, and it is what it is, and it was expected, and we shouldn't get too hyped up about it because it's just there as expected? You see what I mean?
Yeah, I think what's happening is we talk about how they're expecting a recession. That's being priced out, and the data continues to get stronger.
Okay.
What's interesting, overnight, we had some PMIs coming out all stronger than expected, especially the manufacturing side. Firstly, India, then Germany, France, and Japan. So these are all significant economies, and we're continuing to see better than expected growth. The global PMIs, after 18 months of contraction, it looks like we'll now have a third month of expansion. So this is good for demand for commodities.
So yeah, so I guess, okay, so to answer my question is, it is unexpected, this amount of strength. So I guess when we talk about EIA stats, Martha, we're saying we've had some quite bearish stats, and it's just as simple as the storage has been building for crude, and for me, like the closest we can get to is the macroeconomic strength filtering into the US market is the EIA stats, which obviously is just a storage situation, but because you know the production and you know the storage, you can imply the demand. So we finally got some bullish statistics on gasoline and distillates. In other words, there were some decent draws, more than expected, but crude is still building. So I guess going forward, that's probably one, as I said, if the narrative is shifting to back to the underlying market, away from the Middle East tensions, then I think EIA stats, and that was something actually Jorge mentioned to me before we came on, I think that's where the attention is going to be this week, because we need that next indication. So if that's another bullish statistic, then it's quite important. But sorry, I sidetracked you there, James.
What was interesting at the end of last week, we started to see more aggressive sell-off in tech stocks. I mean, what I find particularly interesting about this is the Nasdaq and the S&P peaked the same 10-day period that gold broke out of its 2080 range. So clearly we're seeing the smart money moving out of stocks. Nvidia fell exactly 10% on Friday and is now closed the week down 21.8%. That was a big AI stock leader. And Tesla, we have earnings this week. That's down 7 consecutive days now, the first time that's ever happened. It's now down 52.5% from the highs. And some interesting statistics as well. The OAS is now pricing only 39 basis points of cuts from the Fed this year, but at the same time expecting there's a 90% chance the ECB cut on the 6th of June. So the dollar's getting a lot stronger here. Some interesting positioning. Global fund manager survey shows that hedge funds and money managers are the most bullish on the dollar they've been in 5 years. Fund managers are now selling bonds at the fastest pace in more than 2 decades. So tighter financial conditions, yields higher, dollar stronger. The other interesting point there with fund managers is commodities saw their largest monthly allocation in history.
Yeah, that's bizarre because we saw outflows, you know, as we were leading up to the Israel situation, and then now we're getting massive inflows back in. I guess that's probably showing that they're a lot more sensitive to monetary policy than anything else, right? So
We're also seeing more demand coming out of China, particularly base metals.
Yeah, that's huge, I think, because that's, again, it's always about what's the unexpected. And so many people are talking a bearish game in China because of what they saw in Q1. I think they're not really factoring in how much that's reversing. So again, it's back to diesel. That will probably be a very interesting one going forward.
They've both actually started the week, gold, silver, having quite a large retracement on the day. But as you were mentioning earlier, if you have a strong push higher, then you naturally get a retracement before the next move higher.
See, the other thing is the dollar, right? So the dollar, big performance. And again, probably looking like against sterling and against euro, it should keep going, right? If the interest rate situation plays out as we now think.
Yep.
That should have a big impact on commodities, but we're in that scenario that, you know, you and Jorge were discussing last week about fiscal entrapment and this idea that, the dollar can rally, but the inverse relationship with oil is probably very unlikely, because part of the reason we're rallying is because of a return to inflation, and then you get a lot of inflows to hedge against inflation, and it's actually bullish for oil against the dollar. So it's maybe not something that the world's that used to, this current environment in terms of macro versus commodities.
Absolutely. And if you look at real money, so non-leverage money, asset managers, for instance, insurance, pensions, if they're moving out of equities, out of bonds, where does that money go? It's huge,
right?
Huge amounts.
So assets, and then commodities being a function of assets as well. And that's, it's actually kind of scary in a way, very unpredictable. But at the same time, we were talking about, the end to the bearish volatility story, and now currently people increasingly aware of volatility spiking. And also you talked about equities versus oil being, or commodities at least, being at the highest ever or close to. And that should be coming in now based on the recent...
We've seen that. We discussed it, I think, early in February, that ratio, and all of a sudden that's turned, and now it's starting to accelerate in the favour of commodities.
So I guess that is logical. Yep. So it did eventually happen, and that's kind of good, I guess, from a... navigating the market's perspective. But any more things, anything that we can see on the horizon that could be a bit of a shock?
Well, there's one other thing going back to the commodities that I'm reading more and more at, is a possibility that China's just trying to hoard commodities because they may be forced to devalue their currency, which is another way of stimulating the economy.
Interesting. So they already have quite a good, on the precious metals, they already have, rare earth metals, they've already got quite a good market share of that. But you're saying what? The gold's obviously that they're buying.
They've been buying gold for 17 consecutive months, a central bank, but also just for industrial purposes, buying more commodities from abroad before they devalue the currency.
Which was the whole ploy of like exporting their deflation, right? Which, is it me, or is that not a good thing for the inflation story in the world?
It's a bad thing for Europe.
Yeah.
Because we could easily be heading back to deflation.
Right. But as in people being worried and governments being worried about inflation, it's almost like China's helping that scenario. But then it will go too far, is probably what you think. And then they can't export because they don't have as many exports.
Also, it hurts, if you look at America, we saw this with the Euro Swiss, when the Euro was collapsing back in 2015, is it hurts American industry because all of a sudden they can't compete. And that's where it gets controversial.
And that's where the election campaign rhetoric steps up about trade wars with China, I guess.
So it's good from an inflationary perspective, but for American industry, they can't compete. Then we start to see tariffs, which is what Donald Trump's calling for.
But even Biden is talking snippets of, addressing China as well, right? It's not like he's against the idea, maybe not as far as a trade war, but you think that's, by the end of the year, we should have something on that, especially if this plan that China are putting together comes to fruition, no?
I think it's also partly a vote winner, isn't it? Talking about China talking about immigration.
Yeah.
I don't know what they actually plan to do on it, but certainly Donald Trump seems much more aggressive on tariffs against China.
And this is a great example of, like, we're talking always about oil here, really, right? And it's everything linking back to oil. So again, you know, for a retail trader, once they get access to what we're talking about, the contracts we're talking about, so how does this reflect in oil prices? Well, massively, right? But right now, the current kind of suite of products you have, you can't reflect it. But if we were just to give you, or I was just give you like a indication of that, when we were talking about, was it propane last week? We were talking about the ARB. So yeah, this example, so it's US versus Asia propane. Now that's a big function of freight, but it's also a function of, you know, import-export policy. So if suddenly there was a trade war or an expected trade war by the end of the year, then you're looking at these ARBs that you were talking about, which was Martha was saying to sell US versus Asia in Q4, actually more for fundamental reasons. But this is an example where if you thought a trade war was coming and you've got US exporting to Asia and that's suddenly not going to make its way to Asia anymore because of a trade war, then that's even more bearish to the ARB, right? Everyone's going to sell the crap out of that differential because the US are going to be stuck with that propane that they used to send to Asia. And now it's not as easy because China's been taken out and Chinese are now maybe buying locally, which, you know, other Asian countries are having to compete with. So that's a way to reflect what's going on. That's just one example. There's going to be like a lot. There's the, you know, all the East-West contracts, you know, literally the East versus usually the Europe differentials in diesel and gasoline. They're all impacted by these import-export kind of policies. So that's a way to reflect what's going on and a view for what could go on in the next 6 months. But a bit complicated, but I think that's what I'm so keen to get people to realize. It's like a really interesting market for that. But anyway, let's move to Googling oil. Like, you know, what are the main headlines? Vincent, do you want to take that?
Sure. So the main headline over the past week was the US reimposing oil sanctions on Venezuela after broken election promises, where the Biden administration said that Maduro has fallen short on the pledge of free and fair presidential elections for later this year. In a sense, it is a dilemma for the US government because of their Biden's own election considerations in 2024, because they want to be imposing more sanctions on Venezuela, but also wary of the risk of higher prices, higher oil prices, higher gasoline prices, which has an effect on voter sentiment. But also with more punishing sanctions on Venezuela, that would lead to more economic hardship for the Venezuelan people, which could, you know, as a root cause, spur more migration towards the US, which is a very controversial political issue right now. But it's also worth noting that analysts have mentioned there's limited short-term impact on Venezuela's current production, as the concession is that Washington is allowing Chevron to continue its joint venture with Venezuela's NOC, the PDVSA, which has steadily increased output from 400,000 barrels per day last year to around 800,000 barrels per day at present. But the continued sanctions may hurt the Venezuela's long-term recovery, but in the short term, it probably affect the non-Chevron production, most notably the diluent products. But yeah.
Well, yeah, I'll just say again, trying to link this back to oil always, you know, as you said, macro-wise, not a big impact, but if there's any shift to production, you know, the oil swaps market does react very quickly. So you've got fuel oil in particular, the high sulfur fuel oil in particular. That market's very sensitive to Venezuelan production changes. So you want to keep an eye on that. And you also want to keep an eye on Mars differentials against WTI. So Mars is the Gulf Coast crude that's most like Venezuelan crude and OPEC crude, right? So that tends to be quite sensitive to movements in Dubai benchmark, movements in Venezuelan physical. So if you look at the Mars and you look at fuel oil, that will be an indication, if anyone cares about this recent news. I'll probably argue nothing this time, but you know, this year alone, there's been moves on the back of these kind of headlines, so that they are important to the underlying market. Anything else on the Googling oil?
Yeah, sure. So something from The Guardian, Louisiana's flagship university, Louisiana State University, LSU, lets oil firms influence research for a price. This is an interesting one because it is packed with different political narratives, because in contrast to the UK, which has, in which universities, activists have been calling for divestment with oil and gas companies in Louisiana and certain parts of the US. They want to be attracting these companies in terms of their energy research. So that's related to the LSU's Institute for Energy Innovations research activities, including things like carbon capture utilization and storage. But that goes back to the engagement versus divestment debate with oil and gas companies, how this affects bias in academic research, academic integrity. You have the fact that, okay, yes, sure, oil majors will be looking to increase production, or are they contributing to carbon emissions? But also in the energy transition, these companies will be leading the way in terms of innovation and trying to be the biggest players that are reducing those carbon emissions in the first place. So it is interesting to see what the LSU are trying to do in terms of attracting these companies, but the wider debate, the wider narrative around our oil and gas industry as well. In here, LSU has long had a close relationship with oil majors, but it's also interesting because it was The Guardian that put out this headline, and they're typically a bit more leaning towards the left-wing side.
Yeah, I was going to say it's a very political thing. I'm going to steer right of that. So yeah, have we got anything else? Is there US EPA had an announcement this week, which
so they've allowed another temporary expansion of higher ethanol gasoline blend this summer. This has been a discussion quite a lot recently, the difference between the E15 and the E10. So the E10 is approved for sale all year round. It has 10% ethanol in, and E15 cannot be sold in most places during the summer because it's got too much ethanol in. But it's kind of confusing because it's the Clean Air Act rather than the actual RVP of the gasoline that's making the difference in this. So the RVP, which is the read vapor pressure, has to be lower in the summer than it is in the winter. So it's to prevent kind of knocking and like premature evaporation and stuff. So the E10 has actually a higher RVP than the E15, but because there's been studies to say it created more smog, that it's not allowed during the summer. But there's been debate as to the smog issue, and the fact that they keep allowing it to happen is really interesting. They've allowed the sale of it during the summer for a few consecutive years now, and actually it's been approved for year-round sale in the Midwest in a couple of years, which is going to be really important as well. And I think this is really interesting right now because, of course, it's election year, as we keep saying, and this is really making the corn growers of the United States very happy. The ethanol is made from corn, as we always talk about with the RINs, corn-based RINs. This is going to be something to keep an eye on as well in the future. Definitely. These D6 RINs. So yeah, I think this is an exciting development in the future as well. So keep an eye on the Midwest.
But again, it's easy to link this back to the oil sorts market, the oil market price. Ultimately, there's probably a reason that it's been the last few summers because gasoline prices have been so high. Yeah. So you don't want to, the more you can have ethanol in the complex, the more that's impacting the supply in a positive way, right? You're producing more kind of. It's hard to say, it's not gasoline, is it? So you're producing more ethanol that's going into the gasoline pool, which is then being used as gasoline. So it's more production of gasoline that's being used by the US, and the US being the biggest consumer of gasoline. That is, a bearish thing for the gasoline differentials to Brent, or just gasoline prices in general. So if they took that away, we'd be in a pretty sticky situation. And also the thing with RBOB being the contractor, RBOB being the US benchmark, it is very precise specification of oil. So if sometimes the price can skyrocket based on a technicality, something to do with ethanol, something to do with RINs, the renewable identification numbers that are just, a bit like carbon credits. So, the average person probably doesn't think about that, but you can have a massive, massive rally in gasoline prices because of the situation with corn and ethanol. So it's not irrelevant at all. It's not too niche at all. It's something that's very important. But I guess you're thinking, as in this is suggesting it's just going to be business as usual, but it's just worth noting if they were to cut this, then it would be very bullish, I guess, for gasoline.
I don't think that they would cut this because I think there've been more and more articles being put out recently that there's not a problem with the smog, right, and that there's been more I don't know who it's being funded by, but all of a sudden there's no smog issue with the E15, and especially the corn. Big corn wants E15 to be sold all year round, as you can imagine, and I think the government's going to see the pros of that, seeing as it's all domestic.
Okay, trade idea for the week then.
Sticking with gasoline, we are looking to buy the gasoline east-west. So to buy this ARB, like we were talking about ARBs last week, this is buying the SIG92 gasoline and selling the European EBOB gasoline. The differential's been quite strong recently, and we're expecting to see this continue, as we think that EBOB is going to continue to be weak, as we mentioned earlier, and the East is going to continue to be bid. In terms of European weakness, just briefly, this is US weakness that's driving this weakness in Europe. We've seen RBOB spreads being a lot more offered last week. As well as the rubber weakness, we've seen trade houses looking at Onyx data stepping down to sell spreads, so selling spreads down the curve all of last week. And it just seems that, as you mentioned earlier, that it seems like people were overbought in EBOB, and they have less kind of enthusiasm in being long European summer gasoline now. So I think we're going to have a step down before we see maybe another rally in the future. But to combine this with Eastern gasoline, SIG92 Asian gasoline has been really well bid. The cracks throughout, people are keen to own length in 92. We've seen good crack buying from refiners as well, which is interesting, which could point to maybe unwinding of hedges so that they can reapply later at a higher price, so an expectation of a rally further. And we've also seen MOC buying routinely in a lot of the SIG windows as well. So I think the combination of the two of these things puts this as a good buy.
Yeah, it's a great trade. I think what's good about this is you're saying, let's look at the landscape first. So you had all these issues with gasoline being too strong too early on the physical market that we talked a lot about at the beginning, the vacuum gasoil situation, all that, pushing things to extremes, and couple that with the market being just so long. And so the risk reward being long now when the market's so long is diminishing heavily. So you add sell side hedging flow to that, you add people just taking profit and potentially stops coming in. There's a lot of downward potential in just outright gasoline, gasoline versus Brent more likely. So then you're saying, okay, what's the best way to reflect that? But I'm not bearish. I just think it's been over pumped, over kind of traded from a paper perspective. So then you're looking at what's undervalued, I guess. And what's undervalued is East versus West is like deeply negative, right? So what is it right now? Like minus, is it 1250 or something in May? That is historically very low, right? I mean, this is a lot more room to go up. And I think the other thing is that East tends to go to the West, and then West goes to US. So everything's kind of feeding the US. So the weaker that the West gets, or in other words, the more they're oversupplied, the more they've got their supply situation sorted out. And let's not forget the Dangote refinery in Nigeria, which was the whole point, was to not be so reliant on European exports, which is a very bullish factor for EBOB every summer. If that's now going or gone, then there's a lot of pressure on that supply complex that was, historically very much needed. Now suddenly it's well supplied. So what relative to that can be strong? Well, we've just mentioned the Chinese buying being undervalued now, being underappreciated. So it's probably very likely that actually the market's generally short Singapore or even just short in their mindset. So it's a good thing to buy, because as people start to realize it, they'll be a bit late, probably most likely. And it looks like this is the most undervalued part of the curve for gasoline. So I think it's a really clever trade in that perspective. But then fundamentally, it seems to make sense as well. So I guess you're getting your indications from a lot of China economics and Asian economic data, right, would be probably the best way to think about this. And as you say, there is also people building up paper length. The only thing I would say as well is 92, Singapore 92, in other words, 92 octane, is just the benchmark for Asian gasoline. It doesn't tend to be, of course, there's speculators in it and there's even funds in it, but I think it's historically not the contract that people choose to take risk on when they're speculating, which is actually a good thing for this trade because it's very heavily impacted by hedging flow. And then if people suddenly think, oh, I can see where this is going, this is undervalued, there's more attention on it, then the relative speculative interest in it will be a lot more than usual, which will, you see what I mean? It will have a bigger impact. Whereas we're used to seeing a lot of buying flows in EBOB and RBOB, but not so much in 92. So if it all comes in a wave, then it's going to be very bullish for that differential. So there's a few things that's really interesting. And then it's a trending trade as well, right? So you're not having to fight a bunch of selling flow anyway. So yeah, that's cool. All right, and our poll last week was about gold. Where do we see the gold price peaking? And they got a lot more interest than the week before. And I think we said, based it on the bank's forecasts, ANZ with 2,500, Goldman's 2,700, Citibank 3,000, I think, just for banter, 3,000 plus. And actually, most people believe Goldman Sachs. I wonder if that's a branding thing.
What I'd say is quite interesting here is 79% think it goes to 2,700 or higher. So that's a huge proportion expect it significantly higher, which would help explain the current price action, aggressive move higher, aggressive pullback before we see the next wave higher again.
Yeah, and I think the potential of a bubble forming, right? I was listening to you talk about silver being a bubble in 2011. And I think it always starts the same way, right? You got hype and enthusiasm coming into the media about something, not aware that this has been building for a long time. So then people start to get very excited, but they're very late to the cycle.
The retail traders are last to jump on board the story.
But not always retail traders, right? Like, I mean, hedge funds, a lot of hedge funds think the same way. Like people going on about, cocoa trading. It's like cocoa's been building for a long, long time. So you're interested in it now, but that's been going. So it's to me, that is a good way to define a bubble, right? When you're just hearing it in the media and people are talking about these, they're talking up the extremes and how far can this go, and it's exciting and it's a gamble thing. It looks like gold could be getting towards that. Like, I know there's good fundamental sound reasons for why it is where it is, but I think now we're getting into that part of the bubble curve that's towards the top, I would say.
When you get the speed of movement that quick, prices moving that high that quickly.
Yeah. And then what do we tend to see? A pullback and then quotation marks return to normal. In other words, people buying the dip, and that's when you see the crash. So yeah, that's a great one to keep an eye on. And
the key on that, the critical point is always the base of the first dip. So you get the pullback and then the bounce. Yeah. But when the base of the pullback breaks, that's when it capitulates.
Okay, that's a great one to watch, I think, for gold, because that will be impacted by the smoother the world goes, if you like. So we've now seemingly dissipating a lot of the tension around the Middle East. Then you couple that with, if they do sort out the debt situation, at least, obviously it's not sorting it out, but some kind of stability there, and kind of the interest rate story starting to ease off, then there's less and less reasons to have gold as kind of a panic, what do they call it, flight to safety situation. So then if the bubble price action is working like that, it's losing reasons to hold it, and the Chinese stop buying because, I don't know, they've started to execute their long-term plan, then that's probably a fundamental reason to be starting to say this is probably quite a good sell, if anything.
And the exact key level of capitulation. And on a similar point, we'll see that with Nvidia. It's down 21.8%. It's bounced. But we know everybody's basically long that who trades equities. When it breaks Friday's low, if it breaks Friday's low, that's when you'll see capitulation again.
Yeah, and there's stories that come out with things like Nvidia. Like, clearly it's a great company. Clearly it's got a lot going for it. But the same thing about Tesla. It's now down, you were saying 49%.
52.5% this morning.
52.5%. And it's, I've spoken to people about this, that no matter what, if you hold Tesla stock, it's just forever going to, and I kind of get it, but it's just ignoring financialization, right? Like, you like the company, but that's not the same as speculating on its equity price, right? And that's just all over the place. It must be a nightmare for CEOs. You're judged on it. You're judged on the stock price performance. But once it gets to bubble territory, if someone's going to turn around and say, yeah, your stock's now down 50%. Sounds like very bad, but if it's 50% from a ridiculous high, and like Nvidia might have the same fate, it's not saying it's a bad company, is it? So it's a crazy one, but that is where we are. I think we'll leave it there. Again, thank you very much for tuning in and listening. And please be sure to check out James Brody's new Macro Mondays. That hopefully doesn't mean that you're out of this podcast, but it's a very good, more detailed version of what we discussed today. And there's a lot of good quality stuff, and we'd love to get your feedback on that. So thanks again, and see you soon.